Asian Paints reports a howler in the second quarter. EBITDA, revenue, net profit all decline as the company misses street estimates on all fronts. Falling volumes point to weak consumer sentiment and competitive impact. The stock down almost 8% now.
Aarti Industries falls close to around 8% on the back of a week showing the second quarter numbers. The revenue rises 12%, but profit after tax, margins and EBITDA see a big fall. The company also lowers its FY25 EBITDA guidance after a weak showing in the past quarter.
Biocon jumps close to 5% in early trade after the US drug regulator grants a voluntary action initiated status to its biologics facility in Bengaluru.
Shipping Corporation of India is a big gainer, up 12% after a strong set of numbers in the second quarter. The company delivers a five-fold increase in the consolidated net profit on a year-on-year basis.
On the other hand, we have Anthony Waste Management down 10% after the company reported a weak set in the second quarter, where the net profit fell 56% year-on-year after the sales saw a marginal dip compared to last year.
Hello and welcome to Chartbusters. Well, in the last 10 minutes or so, we've seen a massive surge in the Nifty. We're up close to around 80 points. We were down 120 points in the first 5 minutes of trade. So it's a good recovery. It seems the bulls want to defend this 24,000 odd mark. And the Nifty Bank, that's the one that's popped up, are up nearly around 400 points from the low point of the day. Mangala, screen is looking good?
Screen is looking good. You know, you spoke about the Nifty Bank. Two of the openers are doing extremely well. Not only the Nifty Bank, you have the IT index as well. So the intraday chart of the IT index comes up for you. You have the Nifty Bank, which has seen a big up move. And on the other hand, you should also have the IT index. That's moved to the high point of trade as well. So when both Rohit Sharma and Virat Kohli play, it feels good.
I hope they do.
Let's hope that they last. It's a good start, but then let's see where they go from here on.
Okay, all right. Let's move on then and let's get straight to the earnings. Metropolis Healthcare, the company posted a largely in line set of numbers. The revenue was up close to 11% on a year-on-year basis. This growth was led by a rise in patient as well as testing volumes. We're joined by Mr. Surendran, the CEO of the company. Hi, Mr. Surendran. Good morning and thanks a lot for joining in. Let's focus on the Mumbai market. What has been the growth in the past quarter in the Mumbai market? And could you tell us what is the updated market share? I think you were guiding for it to move up in the coming quarters. So what is it?
Good morning and good morning to all your viewers. And of course, we have had a good consistent quarter once again. And coming back to your question on Mumbai, see, overall, we have had a very good growth in the overall Maharashtra market, not only Mumbai, Pune, rest of Maharashtra, our B2C has actually grown beyond 21%, right, in the market. And, of course, Mumbai market growth is about 15-16%, which is above the company levels of growth. So overall, Mumbai and Maharashtra is looking pretty good.
All right,
and market shares, I missed that number. Earlier you were talking about market share moving to around 25 to 30%. I think the last updated number is 15 to 20%. Are you outgrowing the Mumbai market?
See, it's very difficult for us to read the market share in this industry because, more than 80% of the market is unorganized. We only have the information from the listed companies. So, if I look at it overall sense of the market and, none of the operators have really talked about too big about Mumbai, and our growth in Mumbai is about 15-16%. So definitely all indicators says that we have gained, market share in Mumbai. But how much is it? Quantifying it is very difficult for us to do this at this point of time.
All right. And one is fair to assume that, you will meet your full year guidance that you've given at the start of this year itself. Revenue for the first half is up 13% in line with your guidance of 13 to 15%. Margins as well at 25.5% in line with your guidance of 25 to 26% itself. What I really wanted to know, Mr. Surendran, was what exactly was the growth that you saw in your new centers? How much of the growth in this quarter was led by existing centers? And what is the average realization per patient in both premium and the non-premium segments?
See, if I split the overall revenue growth into the new centers and of the existing centers, right, about the same center growth, we are seeing about 12% above growth in terms of new, the same center growth, which is existing centers growing in excess of 12%. And 4 to 5% of growth is actually coming from the new centers that we are setting up across the country, right? And of course, there is a little bit of churn of the existing center that really is the neutralizing number to 13.4% that you will see. And of course, the realization grown by about 6%. And of the 6% realization growth, if I can split that into price and the product mix,
Right.
about 2 to 3% is coming from the price increase that we did in January this year, and about 3% is coming from the product mix, which is the drive that we are having on the True Health packages as well as the specialty portfolio. And both the specialty is growing by about 16%, and True Health is growing by about 23%. This is helping us to improve the overall realization.
Indeed, I just want to touch upon that because that's where the bulk of the growth is coming in. Specialty and True Health, both of them are growing very, very well. So on a steady state basis, what is the growth you're looking at in both these two segments?
So see, both these segments put together adds up to almost half of the company's revenue.
Yes.
Right. And we would definitely see further headroom available as far as True Health and both True Health as well as specialty is concerned. We would like to take the True Health growth to maybe towards the 20% in the coming quarters. And similarly, the specialty can also get into that level, that range in the coming quarters. And this will continue to be our growth drivers going forward. And of course, our expansion into the tier 3 cities is the other growth lever that you will see playing out for us in the coming quarters.
Right. I mean, it's all of this, if you could give us a sense of what sort of patient volume growth do you anticipate over the next couple of quarters? And on the prices as well, you've taken price hikes of about 2 to 3%. Mix has improved your realizations by about 2 to 3%. Mix will continue to improve because you are talking about these businesses growing faster. Price hikes, they are a function of also competition, right? So to that extent, what is it that you can guide for when it comes to competition and patient volume growth over the next couple of quarters?
So see, we have reported 7% patient volume growth in the last quarter and a similar number in the quarter one as well. And if I split this into B2B, B2C and institutional, we have had about almost 12% patient volume growth in the B2C segment. But what is actually pulling us down on the patient volume growth is the institutional business, which we have, as a choice, we decided to a little bit disengage. And that's why the overall, weighted average of the patient volume growth is 7%. As we go forward, and we will clearly see this is the patient volume growth coming to a high single-digit number. That should be definitely be happening in the next few quarters. Right. And the specialty and the True Health packages is going to be continuously going to be the drivers, and that's going to take the overall realization better, like I said some time back. Price increase, we did a January price increase this year. And normally what we have seen in this industry, price increase normally done about 24 months, 2 years to 3 years time span. So I'm not seeing any immediate opportunity for us to take the prices up. But maybe sometime next financial year at the appropriate moment, looking upon the market, behavior, we will maybe take a call at that point of time.
Very quickly, Mr. Surendran, there have been hospitals that are looking to enter into the diagnostic change, which heats up the competitive intensity. What's your view on that? See,
hospitals are already there in this industry, diagnostic industry. Particularly, we are seeing the big chains of hospitals and in Delhi and in Hyderabad. Are the two places that we are finding the hospital chains have come in a big way. But I think, we are not finding any addition in terms of competition from the hospital chains. And hospital chains will always find it difficult to serve the customer at one price within the hospital and one price outside the hospital. That is going to be a little bit of dissonance for their customers. So we're not, finding it, anything which is really worrisome at this point of time, but it will be a good play to have in the market.
All right, we'll take note of that, and obviously every quarter we will keep quizzing you on the intensity of the competition, patient volume growth and performance of your growth drivers, which are the premium healthcare and specialty businesses itself. Thanks a lot for joining in, Mr. Surendran. Wish you a good second half of this year. Take a short break, come back on the other side, we'll get you more on the markets. But actually, as we slip into that short break, also listen to our idea of profit coming in from our colleagues at Money Control Pro. Today we have Khushbu joining in with a stock.
In today's idea for profit, we have Aditya Birla Capital. The stock has outperformed the market led by strong business growth and announcement of the merger of Aditya Birla Finance Limited, which is the NBFC arm, with the parent company. Recently, the company has received no objection from the RBI and the stock exchanges for the proposed restructuring. The company will convert from a holding entity to a large unified operating NBFC with better access to capital and improved operational synergies. The lending business outlook remained positive, led by strong growth in the NBFC book and increased disbursement in the housing finance segment. On the earnings front, the company posted healthy earnings in Q1 with improved asset quality. Also, the asset management business saw healthy growth in asset led by capital market performance. The simpler business structure stable credit cost, and better product mix will likely aid the ROA in the long term. Also, if we look at the valuation, we see reasonable upside from the current market price with a potential for a stock to re-rate after the merger, which could lift the valuation in the coming period.
The Nifty is up close to around 90 points, and Trent, after seeing a bit of selling in the last few days, that's popped up in trade post that initiation coverage report. But the big point that's really come to the party is HDFC Bank, and we made this point earlier today. That's gone through a phase of underperformance, but now it looks like it wants to take leadership. And in the last few minutes, you're seeing HDFC Bank move towards that 52-week high, which is around 1,800 rupee mark. At around 1,700 rupees, it has the 20 and the 50 DMA. So HDFC Bank has moved up. And what it's done is, it's taken, the Nifty Bank as well past the 20 as well as the 50 DMA. Maybe at some point of time, that as well should come up for you on the screen. Next up on our earnings radar, we have Equitas Small Finance Bank. The bank reported a weakish set of numbers in the second quarter. The MD and CEO, Mr. P.N. Vasudevan, joins us to discuss the company's last quarter performance. Hi, Mr. Vasudevan. Good morning, and thanks a lot for joining in. It seems, the markets are not too impressed with the numbers that you have delivered because your return ratios have been weak for the past 2 quarters in a row. That's predominantly because of the high credit costs as slippages have remained elevated. Give us your expectations on the pain from the retail portfolio going ahead, especially the MFI and unsecured portfolio.
Yeah, good morning. In Equitas, we have 84% of our book, which is a secured book. 16% is our microfinance, which is the unsecured book. As we all know, the microfinance industry has been going through some level of stress. In fact, we have been in the microfinance market now for about 18 years. And this is the first time that I'm seeing something which is really internal factors which are causing us stress in microfinance. Otherwise, it's always been traditionally external factors which have caused stress in microfinance. And this time, because it's an internal factor which is causing the stress, we are also seeing that the stress is not really limited to a geography. It's across the entire markets that we operate. And also it's gone on for a time period which is longer than what we have ever seen in the past. So because of that, I think microfinance is going to remain at some level of stress. And if you see our own results, we have taken a 10% credit cost hit in microfinance for the first half or for 16% book. Whereas the remaining 84% of the book, the credit cost is about 1.03%, which is quite normal. And that 10% includes a one-time provision that we created of 145 crores in the second half. So if you remove that one-time provision, our normal credit cost itself would still have been somewhere in the range of 6.5% for the first half against a standard credit cost of around 2%. So 2% in microfinance will be absolutely normal. But now it's gone to about 6.5%. So that is where it is all showing up. And because we saw the pain, some more pain coming up in the next 2 quarters, we thought, why not we take an upfront provision buffer that we created so that we can have upfront as much of the pain as possible rather than keep on having it coming every quarter.
You said it. There is a serious amount of stress in the MFI portfolio. The good part is that you've upfronted all of those costs. The worry, however, is that despite all of this, there could be increased slippages going forward as well. So I just wanted your thoughts on 2 parameters in particular. One, your slippages in this quarter have been around 505 crores. This is higher by almost 31% versus the comparable period. Annualized slippage ratio also at 5.6%. And that's impacted both your gross and net NPA ratio as well. On a steady state basis for the next couple of quarters, what is the kind of credit cost guidance that you can give us along with quarterly slippages? If you could give us those numbers.
Yeah, so the gross slippage has remained elevated in the second quarter. Largely that is come out of the MFI and partly contributed by vehicle finance also. Vehicle finance, the net impact will not be much because most of the accounts which slip into NPA are recovered. And so the net impact at the NPA level is not that much. But in microfinance, the recoveries also are not as strong once they move into overdue buckets or NPA cases. The recovery is also not as strong as in the secured book, and that's where the credit cost keeps mounting up. From a guidance perspective, we really are not wanting to give a guidance on the credit cost for the second half. But that 1% that we have on the 84% of the book, traditionally, the second half of the year has always been very strong, whether it is disbursement or collection. So that 1% we should see it coming down a bit on the 84% of the book. And the 6.5% normal credit cost of the microfinance, removing that one time that we made, that 6.5%, the question is when will it come to the 2%, which is our normal? If it comes, then our total credit cost will be around 1.25%, which is what we normally have. The question is whether it will come to 2% anytime soon. And we have put in a lot of efforts, both at the industry level and at our bank level. Initiatives have been rolled out in the field, trying to get more people onto the ground to spend more time with the customers, etc. As well as we have introduced a few new products and offerings for the customers. Since we are a bank, we have a wider bouquet of products to offer to try and help them come out of the over-leveraged position that they are in today. And so that 6.5% of normal credit cost that we saw in the first half, even if we can reduce it to something in the range of 4% or so for the second half, I think that will still be very positive for the bank, because that 1% on that 84% will anyway come down. And this 4% coming down on microfinance would mean that our overall credit cost should be something reasonably close to normal.
Got it. Okay. All right. That's fairly explained then. Tell us about NIMs. They've contracted yet again. What is the contraction you're factoring in for the second half of the year? When do we see the NIM growth come back? And also, if you could tell us what kind of deposit growth you're factoring in?
Yeah. So the NIM is generally impacted by three factors. One is our cost of funds. Second is our lending yield. And third is the NPA movement, because every time an account slips into NPA, we have to reverse the income that has been recognized on that asset. And so that has an impact on NIM. So if you look at the three components, our interest cost, if you see, has been steady over the last 2 quarters. It's around 7.5%. And we have peaked on our interest rate. So I don't think our interest rate is going to go up any further. Interest cost is not going to go up any further, assuming that steady state interest rate in the market. On the other hand, we actually tweaked our savings account balance slabs a bit in the first quarter. We tweaked it again in the third quarter in the month of October, as well as we reduced our peak interest rate on deposits from 8.5 to 8.25 in the first week of October, because of which we expect to see a marginal reduction in our interest cost over the next 2 quarters, even if interest rate in the market remains at same levels. So that is on the interest rate. The second comes on the yield. On the yield, if you see at the presentation that we have set up, our yield has actually remained at the same level as the first quarter, indicating that our lending rates are holding up, and we don't see much of an issue in terms of maintaining the yield on the book. The third component now finally we come to is the interest reversal because of extra NPA movement, which is the real problem that we have seen in the first and the second quarter, and that is what is impacting the NIM significantly. And so that we'll only be able to reverse that as and when some of the accounts get into more normal mode. So that is something that we have to just wait. But fundamentally, we don't have an issue on NIM. As and when we are able to get the stress in microfinance sorted out, then we should see the NIMs holding up and maybe moving up also.
All right, Mr. Vasudevan, we're out of time, not out of questions. So we'll, request you to join us once again for a more detailed chat on how you plan to, alleviate the situation that there is in the MFI space with your feet on the ground, etc. You're talking about getting the customers out of their over-leveraged positions. What are the measures that you are taking to ensure that that happens, and the kind of impact that could have on your OPEX, etc. as well, is something that we'll discuss. We invite you for another conversation very soon as well. With that, take a short break, come back and get you more on the markets and a lot of stock-specific action. A lot of stocks buzzing around right now. The Nifty is still holding with gains of almost 80 points. Welcome back. A bunch of stocks actually now picking pace right now. We have PFC, which has moved to the high point of trade, along with REC. So PFC, REC are doing extremely well. Power Grid as well. So a lot of these power stocks are actually spiking right now. So Power Grid has moved to the high point of trade. among the top gainers right now on the indices. We have PFC and REC as well sitting with gains of almost 4 to 8%. And the other one which has also picked pace is Trent, that initiating coverage from Goldman Sachs and a big decline from the highs has perhaps, made some people take note of Trent as well. And with the kind of numbers that have come by, now people are looking at Trent in perspective as well. A 39% revenue growth with a 47% EPS growth. But Trent isn't the only fashion company which is gaining. We're also seeing some traction in AB Fashion and Retail. That stock too up around 2% With that, what we'll do is we will wrap up on this edition of Chartbusters. But as we do that, here's some programming note. As CNBC-TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of this year, the CNBC-TV18 Global Leadership Summit. It's on November 14th, starting 10 a.m. onwards. It's a power-packed day with several panels focusing on India's economy, digital landscape, markets, even entertainment, a lot more. Only and only on CNBC-TV18.